Oh, to delve deeper into the market story, I'm joined by Tato Mashiko. He's a portfolio manager at Sanlam Private Wealth. A very good afternoon, Tato. Thanks very much for joining us. So the feeling is that US interest rates will remain higher for longer. We've also heard the same of South Africa. And at the same time, there's the usual Democratic and Republican fighting over budget that risks a government shutdown. How are these factors feeding into US markets as well as broader international markets?
Well, good afternoon, Nampu. I think there's definitely a lot of concern with the forward trajectory if we look at the US. So on the one hand, we know that the soft landing thesis has been quite popular for most of the year, but we've seen that the S&P 500 has declined around 5% this month, so the first negative month. And that's, I think, on the back of, on the one hand, more hawkish sentiment from the Fed. So obviously rates are going to remain higher for longer, but also concern in terms of underlying economic performance. We can see it through, for instance, rising credit impairments on vehicle loans, as well as other areas of the loan book in the US. So there is some concerns around that. And of course, when you have specific political events like potential government shutdowns, as well as continued auto strikes from the auto workers, that also feeds into, I guess, additional risk as well as potential inflation for the market.
So the local equity market doesn't really seem to be catching a break when it comes to, you know, being on the up. I mean, earlier when I was looking at markets, but I've been in studio since 12 o'clock, I saw that it was only the resources counters that were on the up and everything else was down. Is this all a product of the fact that we have poor economic fundamentals in South Africa? And on the flip side, where do you see opportunities for investment if that's the case?
Well, I think definitely if one has a look at our bond yields at the moment with the 10-year close to 12%, it does speak to rising concerns from a fiscal perspective. So we know that tax collections have been relatively poor this year. And this is, on the one hand, because of reduced commodity prices. And so we're not getting, I suppose, that benefit we had in the previous fiscal year. But on the other hand, general corporate receipts have been weaker as the economy has slowed, and we know that our GDP outlook is, of course, not too inspiring where it currently is. And heading into an election year, there's concerns of a risk of heightened government expenditure. So obviously, that doesn't bode well from an overall fiscal perspective, and that has led to capital outflows, and of course, a weakening in the currency, which then has knock-on impacts on inflation. So there is definitely concerns around that, and we see it through pricing on the bond market as well as on the equity market outside of the resources space. There's definitely pressure on multiples in other areas.
So how worried should we be about the oil price? It looks like it's just a few ticks away from $100 a barrel. Obviously, that could mean or suggest more inflation globally, which is not great. But it's great for the likes of Sasol, which I saw the share price there had ticked up.
I think definitely in terms of the outlook for Q4 of this year, we will see continued elevated oil prices. And that's just a function of supply and demand. So on the supply side, OPEC Plus has continued with their rather steep cuts of around 1.3 million barrels per day that Saudi Arabia and Russia have taken out of the market. And of course, this is in order to boost prices and their own, I suppose, fiscal situation. On the other hand, demand has not softened. And I think the market had previously expected, especially in the face of slowing economic activity, that we would see demand softening, which would then recalibrate oil prices. But we are still seeing strong demand, and that could be a number of factors. One, for instance, the US starting to replenish their strategic oil reserves. And we saw recently that in the past week they drew down 2.2 million barrels in terms of their reserves. So clearly that could be one of the drivers in terms of demand, but also it could be general demand in other areas. And so we're likely to see an elevated oil price. We could reach $100 per barrel, and it will likely remain elevated this year. Going into next year, we'd have to see what OPEC decides to do. And of course, we could see further economic deterioration. So a pullback could happen in Q1 next year, perhaps.
A very brief comment on Capitec's half-year results.
Yes, I think the Capitec results are probably a tale of two stories. On the one hand, we saw positive growth in the loan book, I think especially on the business side. So, business advances north of 20%. Non-interest revenue was very positive. So on the insurance side, they're writing a lot more business on their own life license. I think 250,000 life policies, as well as continued growth on the funeral side of things. On the negative side, perhaps we are starting to see higher credit impairments and as a result, increasing provisions. So I think bad debts rose somewhere around 60% year on year, and provisioning as well increased significantly. So somewhere to the extent of, I think, close to 10% of the bad of the book is now being provisioned for. So that speaks to obviously concerns around the consumer, specifically the retail portion of the book going forward. And they're probably cutting back in terms of lending applications and obviously lending out on the retail side of things. So it does speak to a weaker economy as a whole. So a bit of a mixed bag, positive in terms of being able to grow in other areas, but also negative in terms of outlook for consumer spending going forward.